Welcome to Arise America. I'm Andrew Schmartz. It's Turnaround Tuesday on Wall Street with investors' stomachs doing most of the turning. It was a wild ride with the Dow Jones staging more than 1,000-point swing through the day. It opened down 500 points after a sell-off in the Asian markets and then came back to be up over 500 as buyers enter the market. For a time, the Dow was in correction territory as defined by a 10% drop off the highs, but now it pared its losses from yesterday by half. For the rest of the market swing through the day, both positive and negative territory. This followed yesterday's historic sell-off where the Dow dove more than 1,100 points. So let's take a look at the final numbers. The Dow finished the day up 569.12, and most of that happened in the last 90 minutes to close at 24,914. The S&P 500 also up, and the NASDAQ up better than 2% at 148.36. Sam Stovall is the chief equity strategist at CFRA Equity and Strategy. Here's what he had to say.
Strong. We're looking for 18% earnings growth for the S&P 500 in 2018. We expect to see real GDP rise by more than 3% this year versus a sub 2.5% growth in 2017. So I don't see a recession on the horizon, and as a result, I don't think we're going to be morphing into a bear market.
To help digest all of this is Gabe Borenstein from Enclave Capital, the Senior Managing Director. Gabe, welcome back to Arise. It's good to see you again. So let's start with the big picture. What happened over the last 2 days?
I think basically what happened in the past 2 days, my opinion, is the explosive end result of ongoing and persistent warning from the market gurus about, and some Fed officials, about potential of a market correction.
So the Fed official would be Janet Yellen, who gave an interview on Monday, a former Fed official.
She had issued many warnings to the markets in the past. However, the most relevant catalyst seems to be the GDP data, which reflected 2.3% growth in 2017, which is better than 1.6% attained in 2016. However, it missed the Fed's objective and historical average growth of 3% by a mile.
What about the specter of inflation? You know, we hear, you can turn off your cell phone, that's okay.
I apologize.
It's I think that was Steely Dan making an appearance.
I apologize. I truly apologize.
That's okay. The inflation issue. This is a double-edged sword. We talk about how great the economy is and earnings going, and then we say, oh my God, there's inflation. This is bad.
Basically, the Fed's target inflation, which would be one of the components that would justify the monetary reversal, is 2%. 2%. We have never attained that. The greatest inflationary risk is demand pull inflation, which is not a risk. Why? Simply because that would be driven by consumer demand. However, in 2017, consumer debt reached a record. Basically, even with the tax abatement and allegedly net increase in the wages of 2.3%.
So when you say this was an overreaction then by the market, somebody got spooked, and that this is a one-time event, and because their buyers came into the market today, that the market has been stabilized, and maybe we hit a bottom yesterday?
I cannot say that this is one-time event. All I'm saying is that the data is misinterpreted. It's not bullish. It's not inflationary. We are missing historical averages on a GDP growth. We are missing Fed's defined targets on the GDP growth and inflation, and the alleged unemployment data, which allegedly reflects full employment, is distorted by a major decline in labor force participation rate from 2007, where it stood at 66, now it's 62.7. On top of it, you have 5 million Americans working part-time involuntarily, which means they cannot find a full-time job.
So the unemployment numbers are a little bit skewed.
Misinterpreted.
Misinterpreted. Gabe, you're going to come back later in the show.
Sure.
Without your ringtone.
I
I
apologize.
think it was Leonard Skinner.
I apologize. Yes, I apologize.
That's okay, and we'll get back to you. But there's a lot more to talk to you about.
Sure.
Back now to the wild week on Wall Street so far, and it's just Tuesday. For most of us, the question is what to do as a regular long-term investor. Gabe Borenstein from Enclave Capital rejoins us. I want to start with something called the volatility index. We hear all this about, quote, volatility, and people throw it out without necessarily understanding it. We have a chart of what's known as the VIX. It's the index that measures volatility. Explain to us how volatility factor into this market, and it's really a fear chart, correct?
Yes, basically it's a measure of anticipated 30-day volatility based on S&P 500 options. Volatility index reflects many variables. One of them could be fear, but it also it is anticipatory of probability of other variables, geopolitical duress, some economic unexpected jolt, etc.
Do you think it's a valuable index because we keep hearing it and seeing it, and if you keep telling people enough that this line here means total fear, sell everything, that people start to panic? Because I got a sense that that's what took over the markets yesterday.
It was contributory to what transpired. From my perspective, because of the rapidly changing environment, whether it's economic, geopolitical, diversity of opinions and perceptions, I think volatility index is actually a dangerous tool to utilize.
Yeah,
that's my personal opinion.
And people actually trade this tool, which maybe even more affects that.
They bet on volatility itself, that will go up or go down.
Okay, let's talk about the average investor who has their retirement funds in the market. The traditional response has been take a breath, sit back, because if you sold yesterday, you lost out on about a 50% recovery today. Is that still the basic message you would tell people, long-term investors?
I would say that this is my perspective, there are two variables from my perspective that allow to sustain this unprecedented stock market rally from 2009, ignoring warnings from various Fed officials.
We're in an 8-year bull market.
Yes.
Don't get, President Trump talks about everything about his administration.
But I'm just giving you a little bit broader perspective.
Yeah.
So basically, since 2009, we have incredible rally sustained in spite of the warnings by geopolitical risks, which have a sort of which profile the United States as the global safe haven. And obviously,
there's not much competition for people's money.
That is correct. That is the most logical, answer. Plus, we also have a very sustained and very moderate recovery, which had prevented the Fed from raising rates to the point where you could end up with a cyclical decompression, as we've seen in history many times.
Well, there's been accusations that the Federal Reserve created what we call an asset bubble, that part of the booming stock market was the result of artificial money, or real money, but artificially pumped into the economy through all the quantitative easing, what we know as a stimulus. They're now pulling that back because the economy is better. Is that an accurate statement?
I don't believe so.
Okay.
I think the magnitude of a great recession was underestimated, and we're dealing with a new normal. The new normal requires and demands a very facilitating monetary policy, which demands extremely low interest rates from historical perspective in order to sustain economic momentum. So that's very important.
So we shouldn't be spooked because interest rates remain low, obviously, if you look at the 20-year, 30-year history. So should you say to investors, don't get spooked by rising interest rates right now?
Let me just preface this.
Okay.
In spite of unprecedented monetary, aggressive monetary facilitation and all the fiscal stimuli in place, we sustained, from historical perspective, extremely moderate economic progress, even as reflected by 2.3% GDP growth in 2017. From my perspective, I don't see that as a bubble. I don't see that as a risk. However, being a senior managing director for Enclave, I would not want to give individual investor decisions on a market investments. The only thing I could say is I don't see anything on the horizon which could possibly dramatically change the current market upside, which demands, again, monetary facilitation and sustained economic marginal growth as we had.
And for the record, I mean, 2.5% growth, if we hit 3% growth, many people may see that as historically low, but we're an extremely mature, complicated economy in the United States in large. I'm not sure how much growth we can get. I mean, there's a Fed report that says we could have 5.5% growth this quarter. That seems to me pretty ambitious.
In the fourth quarter, several federal districts had indicated potential GDP fourth quarter growth between 3.5% to 4%. The posted GDP growth for the fourth quarter was only 2.6. So I'm not really impressed by these models indicating forward projection of the GDP growth. The 3% growth is a historical GDP growth since 1948. In this recovery, we had failed to attain it in spite of all the aggressive monetary policies and other fiscal stimuli. And I would say, again, that reverts to a new norm, result of the unquantifiable damage inflicted on the U.S. economy by the Great Recession.
For general investors, all we talk about is stocks. There are a lot of other things to invest in, and bonds are among them, especially for people who are on fixed incomes. Yes. Now, the bond market is getting routed, but interest rates are going up. Should investors who are not well balanced in their portfolio start thinking about being serious about balance?
Again, I don't want to
give.
My perspective is that inflation is not a risk in this continuous cyclical, sustained economic momentum. As long as that is the case, and given the magnitude of geopolitical pressures, meaning external issues, we could see a global convergence, flight to quality into U.S. Treasuries.
Into Treasuries.
And that could prop up and induce a major rally in U.S. Treasuries still.
And still, even with U.S. Treasury prices?
Absolutely. There was a correction to around 2.82 on the 10-year Treasuries. We rebounded to about 2.74. From my perspective, any external issue as reflected by North Korean threat of nuclear weapon, you could see.
That's right. There's always a political threat that
could
that
see
upsets
10-year
the apple
Treasury
cart.
rallying right to 2%.
Sure. When we talk about inflation, we hear a lot of economists refer to what we see as wage inflation, which is the same thing as saying people are getting pay raises. At what point, and is there a point where that does tip into an inflationary environment? The White House, chairman of the White House Economic Council today, advisors, said that he does not believe, as an economist, that wage inflation results in inflation. It's obviously good to have that view if you're the Trump administration, because you want to see people's wages rise through tax cuts and whatever else they're providing.
In 2017, the wages have increased 2.3%. Adjusted for inflation, that's a very marginal increase. U.S. consumer entered 2018 facing with a record personal debt, and I believe that even if you had a higher real wage increases, and remember 18 states had implemented raising the minimum wages, I believe that the most logical resolution will be for the U.S. consumer to address their debt issues.
And stop spending.
I would say we are facing a risk of contracted spending given the financial limitations imposed on the U.S. consumer.
And possible deflation?
I believe, in fact, deflation is the real risk because if a global economy entered turmoil, and we could precipitate this, you're going to see OPEC cartel quotas falling. You could see oil prices decline, and that would be prelude to a major disinflationary trend.
And rising interest rates and deflation, a bad combination.
The rates would decline in a major way.
Gabe, thank you.
Thank you.
Okay.